In today's complex financial landscape, consumers in Ireland need to ensure that they are receiving advice from the most qualified professionals. The QFA, RPA, and notably the Certified Financial Planner designation are the hallmark of excellence in financial planning. Each signifies rigorous training, a steadfast commitment to ethical standards, and to continuous professional development. For somebody who is selecting a financial planner with these credentials, a consumer is entrusting their financial future to somebody who is comprehensively equipped. It is not merely about choosing a planner. It is about securing a sound and prosperous future with the guidance of a true expert.
Hello and welcome to Pension Awareness Week. This session is for starting a pension for business owners. Getting your pension offering right for management and for staff can make a real difference. Running a small or medium-sized business, or indeed forming a new business in Ireland, means wearing a lot of hats. Directors and small owners of companies and business owners have unique opportunities, however, to use pensions in a way to extract value from their companies in a highly efficient manner. So whether you're starting from scratch or you want to improve your existing pension arrangement, this webinar will hopefully help you get to grips on what pensions can do for your wealth through your company. Separately, there has been a large number of regulatory changes within the pension sector over the last few years, which are having an impact on the pensions for the self-employed and business owners. These include the introduction of advantages of using the PRSA over the single-member executive pensions, to the pending introduction of auto-enrolment. Intended for owners and the self-employed, this session is going to focus on how some of these regulatory changes are going to impact you and what practical steps can be taken by all of us business owners to take advantage of them. At the same time, we're going to explore why strong pension benefits offering is a great way to recruit, reward and retain new staff. And if you set up your pension offering right, the administrative burden on all involved can be minimised. Fortunately, it has never been easier for SMEs and new businesses to put a compelling workplace benefits into place. Whether you're starting from scratch or want to improve your existing offering, the purpose of this session is to explain how. Having been set up back in 2019, the objective of Pensions Awareness Week was, and still is, to empower people and companies in Ireland to take charge of their pensions. Joining me to discuss these questions is a panel of experts from across the Irish pensions and accountancy industry. So on my left, I have Olive Ryan. Olive is Head of Client Services at Moneycube.ie, and you're an investment advisor as well. Your focus is on making financial services comprehensible, inclusive and meaningful for people who want to take charge of their financial future. That's a very big bio. And in the centre we have Susan Wiley, partner at PKF Accountancy Practice. Susan is here today representing both the SFA and the PKF. Susan is one of the partners responsible for overseeing the business services and outsourcing side of the practice. The business services and outsourcing department provide accounting, management accounts, personal and corporation tax services to small and medium clients. The clients range from startups to owner-managed businesses and large corporate entities. And lastly, we have Jared Tyrrell, who is a pension consultant with Zurich Life. Jared has 12 years experience in this industry, and he's been with Zurich since 2011. In his current role, he provides advice to the financial brokers and advisors on the technical and legislative issues surrounding pensions. So we have a wealth of knowledge and experience here on the panel today. So as we all know, we're talking about SMEs and small business owners and entrepreneurs. And as one of those myself, this is a really fascinating topic for me because I am, probably indicative of a lot of people out there. I know a bit, but not a lot, and obviously with everything changing at the moment, I need to get up to speed on what's going on and basically how to make my money work for me. So Olive, tell me, as a business owner, what's special about me or all the business owners out there, like in terms of when it comes to looking at our pensions?
Okay, so there's quite a distinction between a business owner with pensions compared to an individual or maybe an employee taking out their own pension. And one of the first differences will be contribution levels that are allowed. So revenue the tax relief will always, which relates to pensions, will always dictate what people can contribute to them, and revenue puts some strict rules around that. But for company owners and directors of businesses, they can actually contribute potentially more in any given year than an individual who's contributing to their company pension or to their own personal pension.
Kind of what percentage?
So the percentages, there isn't really a set percentage for a company. It's driven by a calculation of what they can fund up to. But for an individual, to illustrate it, if you are taking out your own personal pension, you would be guided by a percentage of your salary depending on your age.
Okay.
And the percentage increases as you get older, but for someone, say someone in their 40s, they could put in 25% of their income into a pension in any given year. Whereas a director of a company who is making a contribution where the company pays the contribution, that could be quite a big difference in how much the company can pay into that pension for them. It's a really useful tool to use cash that might be sitting in your business account. So the company is making the contribution as opposed to the individual director themselves. And so the company, instead of, you might decide, I want to invest this money, it's sitting in the business account, and it's not, bank rates are no better for businesses than they are for individuals. So what will you do with this? If you don't think you're going to need that fund for the business in the next few years, then a really useful tax efficient thing to do is to put it into a pension for you as a director of the business or the business owner. Your pension fund will grow tax free.
Okay.
So, but it is locked away. So that's the catch. It's locked away until you retire, and that means you are actually walking away from the business potentially. So you are locking it away. So, but it is going to grow tax free as opposed to the tax that would be paid on the gain of an investment if you just said, let's put this money in an investment for my company. And it can be offset then as an expense in the business account as well. So there's a tax benefit for the business that way. Okay. So there's two kind of tax breaks there, but the difference is that you can contribute a hell of a lot more. There's a maximum fund of 2 million for anyone with a pension, but to reach to that level, that's the threshold that revenue place on pension funding. But to get to that point, a company can contribute, a week before you retire from your business, potentially, a company could contribute 2 million into a pension fund, depending on what structure you use. There's a couple of different structures, but that's the potential there. So it's quite unique.
It's quite a lot of planning, though. You need to really plan, don't
absolutely,
you?
Absolutely. And it is, definitely talking to your accountant or talking to a financial advisor for certain is required to make sure that you're making the most of those opportunities.
So Jared, this is kind of your forte, retirement planning, effectively. So can you give us an overview of what's involved in retirement planning, and like where do we begin?
Yeah, so at a basic level, retirement planning is just having a plan for how you're going to replace your income when you stop working.
Okay.
Now for an employee, they may have to take less action because their employer maybe provides a pension scheme, so they have to think about this less. But business owners themselves have to take action. They need to engage with a financial advisor because no one's going to put a pension scheme in place for the business owner. They have to do that themselves. But at the same time, as Olive was saying, the rules in Ireland for business owners are really advantageous tax-wise. There's a unique opportunity for business owners to use pensions to do two things really: extract the profits from the company in a really tax-efficient way, and also plan for this future retirement. So plan for this future exit, whether they want to sell the company, whether they want to pass it on to their children. And even some cases they might want to continue on working, but it's still a really good idea to put some kind of plan in place.
Okay, so there's been a lot of regulatory changes that have happened recently. So how does this affect or impact business owners at the moment?
Yeah, so
What's the main thing they need to be aware of?
there's lots of things they need to be aware of, and I think a financial advisor is actually key in navigating that.
Yes.
I mean, the industry has seen a lot of change in the last 18 months. Like every other industry, we're subject to EU regulation. So if EU law changes, we have to change with that. There's a piece of legislation called IORP2. IORP2, which is it's in a simple sense, it's affecting the kind of pension schemes that business owners would have traditionally used in Ireland. So traditionally, business owners used a single member executive pension. Now, IORP2 says that we can't have single member executive pensions anymore. So what business owners are probably seeing, and some will have seen it already and some will see over the next few years, is that they're having to transition their pension schemes to a new vehicle. Okay. And the good news for the business owners is there's actually a number of options available to them now. So most pension providers have a master trust in place. And the idea of the master trust is it's a large scheme where multiple employers and multiple employees can participate. And it does satisfy these new EU regulations, but it allows you to fund in the exact same way that you did fund under your single member executive pension. In addition to that, we have changes that our own government made in relation to the PRSA product. That's just another kind of pension scheme. It's a personal retirement savings account. And those changes are actually really advantageous for business owners as well, because they allow them to fund even more so than under the traditional occupational scheme model, the executive pension model. So I suppose the message to business owners would be, talk to your financial advisor, see how your pension scheme is, see do you need to change to a new product, and have the conversation as to which product is best for you.
Okay, well, what were the PRSP or SA changes like? Can you outline those briefly? So
the government introduced a change to PRSA legislation, which essentially meant that there is no upper limit now on an employer's ability to fund a PRSA. Okay. So traditionally with single member executive pensions, we had to do a calculation to see how much a company could put in a given year for, say, for example, a company director, which would factor in how old they were, how close they were to retirement, the kind of salary they were on, and also the pension they had built up to date. With the PRSA, we have a much more simple approach. There is no upper limit on the employer contribution to a PRSA. So as Olive has highlighted there, if a business owner is funding over a really short term, if they plan on selling their business soon or they plan on retiring, the PRSA has become really advantageous because that allows the employer to put in up to €2 million in one go, which is a real acceleration in the ability to fund. So it's been really positive for business owners.
What are the drawbacks to these changes? What are the kind of hurdles that people are going to face?
I suppose, like everything in the pension industry, we now have more complexity. So we have lots of questions around which product is best for me, should I move now, what are the rules in this product versus that product. So I suppose in Ireland, we are trying to simplify pensions and the government are trying to simplify pensions, but
are they really?
There is an attempt from government to what they call harmonisation and simplification. So harmonise the rules, have less products, have less jargon, much more simple landscape. But as things change, some things never change, we find in the industry. And so what the main point I'd be trying to get across to a business owner is there's big opportunities here. There is a degree of complexity. Talk to your financial advisor, but ultimately these are positive changes for us because they allow business owners to fund even more so than they did in the past.
What if you're a very small business owner, i.e., you're not on making huge turnover or huge profits yet? Is this something you should be looking at now, or is it really only when you have adequate cash flow and adequate profits effectively in the bank?
Yeah, I suppose what we would say to clients is in the early years we find with SMEs, clients have to work really hard to establish their business. They may be taking low salaries, they can just about cover their lifestyle. They may have to suffer in the context of their lifestyle. But when the business is up and running and things get going, as soon as they start to build up profit in the company accounts, then they need to start having these conversations as to how to best extract that profit. Some businesses might like to hold profit back just in case they have a bad year next year so they can cover their own salary or maybe some of the employees they have. But as soon as you have profits accumulating, you should be looking at the best way to extract it. And this pension planning is a really tax efficient way of doing that.
And one of the great things about pensions, there are great things about pensions, and one of them is the flexibility of it. So you don't have to commit to a certain payment every year from your business. You can choose how much you can afford from your business to put into it. It might be something you contribute a small amount monthly, or you just do something at the end of the year when you're doing your tax return. You're talking to your accountant, like Susan's clients would be making that decision. but it's flexible, you know. So whatever you contribute this year, you're not committing to the same amount next year. You might not make a contribution next year, you know. So I think that the flexibility of pensions is really positive for business owners.
How flexible is it? Like if you commit to putting in X amount every month and suddenly your business takes a nosedive in the middle of the year for unexplained reasons, are you able to kind of do you freeze the plan and step back in a year later, or do you?
Absolutely, yeah. You can pause at any time. You can reduce the amount. You can increase the amount. And like I said, for a lot of businesses, small businesses, it's really more the end of year, and they are more likely to be a single lump sum amount that's contributed rather than a regular monthly amount. But you can skip years. You know, you don't have to contribute continuously. You can do the contributions that suit your current year's profits.
As a business owner, I know you're all on this trajectory, and then suddenly something happens and you're like, pulling back in the money, and you're like, obviously the pension pot is one of the first things to get hit, you know.
It is one of the first things to get hit, but obviously I suppose if you can look at the longer picture and weigh it up, and that's where it's good to talk to a financial advisor and weigh things up to see what else, how can I restructure maybe the finances in some fashion that allows me to continue to make some contribution, because there are tax benefits at the end of the day with a pension fund.
Okay. We would see that as well with when it comes to just before the end of somebody's financial year. You're looking at the corporation tax that'll be paid.
Yes.
And if the profits are at a certain level, one of the recommendations we'd often give is to consider putting a top-up payment into their pension fund. So they might be paying a small monthly amount, and then at the end of the year, if they were having a good year, they can put an extra amount in. But even, let's say, if we look back for the last few years, it's been a difficult couple of years with COVID. So there's a lot of companies who weren't able to trade, so pensions were just paused. And now that things are getting back on track, they were able to then start the pension contributions all over again. And so it's flexible.
And there's an investment element to a pension. So whatever you've put into the pension, that's still invested.
Yes.
So it's not, you haven't just thrown your money into something and it's just sitting there. It's actually actively being invested. So even if you're not making a contribution, you should still keep an eye on it, check that, you know, the funds are doing what you want them to do, that they still meet your needs, that the projections that you'd hoped the fund would achieve at the end of when you reach retirement age, it's still on track. So it's still worth checking in, but don't forget that it's an investment at the end of the day, so it's still growing, hopefully, in the right fund.
Okay, so auto enrollment, that's just one of the big headlines, the buzzword going around the industry at the moment. Susan, can you explain, just in layman's terms, what does it mean? What does it mean for everybody? You know, should we be scared of it? Is it a good thing?
Well, this is something that's been discussed over the last number of years, and the plan for the government is that it's going to be a pension fund, that's a pension savings scheme that's put in place, but all employers are going to have to put it in place, and staff will be automatically enrolled into it. So the staff members will be automatically put into the fund, and it'll be applicable for people who are over 23 years of age and up to the age of 60, and then also people who have a salary in excess of 20,000. So if you meet all that criteria, the employer will be obliged to register those people automatically register them into the enrolment fund. And then what will happen is the individual will pay a portion of their salary into the fund. The employer will match it, but then the government will also give a contribution into it.
Okay.
And the starting rate is 1.5%, and that's for somebody who's in employment between 1 and 3 years.
Yes.
That would go from 4 to 6 years, then that'll increase by another 1.5% up to 3. The next one will go to 4.5%, and anybody with you over 10 years, they'll be contributing 6%, and then the employer also contributing 6%. Okay. So it is something that...
Is the government contributing 6% as well?
No, the government will, if you're on the starting 1 to 3 years, they'll contribute 0.5%, and then for the next period, they'll go up to 1%, then up to 1.5%, and then up to 2%.
And then they top out.
Yes, if you're putting in 6%, so is your employer. The government will be putting in the 2% then.
Okay.
So it's a scheme that'll be very beneficial for the employee. Now, for the employer, it's as I say, they will have to participate in the scheme unless they already have a pension fund in place.
Okay.
So there's a lot of large companies already who have a pension scheme in place. Their employees have an option to be in the scheme or not. But for a company that has no employer pension scheme in place, they will automatically have to sign up to the scheme.
Okay.
So there is an opportunity there at the moment. Each employer will have to consider, what will I do? Wait for auto enrolment, which is due to happen latter part of 2024, or they could discuss with the likes of JER or even with the likes of Olive, and they could put a company scheme in place.
Okay.
And if a company scheme was put in place, again, there could be more flexibility from the employer side of things, as opposed to going into the rigid scheme which will be in place for auto enrolment.
Okay, and is there any like size constraints here? Like, does the company, have to be employing a certain amount of employees, or it'll really be across the board whether you have 2 or 2,000?
It'll be across the board.
Okay.
Yeah.
Okay.
And as I say, the plan is that it'll be automatically happening. The information coming from government at the moment is saying latter part of 24.
Okay.
It has been pushed out previously,
soon, yeah.
and it is something I think employers need to be made aware of it, and even, as I say, start looking and investigating what will happen. Because it is, as I say, it's a tax on employment.
Yes.
So if you do take on an employee, you have the employer's PRSI, but you're now also going to have a pension payment that's required for employees.
Okay.
So again, the existing employees that are already there, you're going to have to contribute for them as well as every new hire.
Okay. They have this in a lot of other countries, so it's not like a new kind of concept really, and it does, I don't know from your experience, it does seem to work very well in other countries.
It has worked very well in other countries. The UK brought it in not too long ago. It's been around for a long time in Australia and New Zealand, and it has worked very well. I suppose it's just a matter of introduction and getting used to it, and there is a fear, until there's enough information out there, and I think that's what we're finding is the issue at the moment. There's just not enough information out there that's concrete, because it's still being confirmed. There's a lot of the areas of the rules around it that are still uncertain or still being negotiated with certain bodies. So I think once we know exactly what's happening and when it's happening, I think it would be much easier for employers to get to grips with it, and then start having conversations about what to do. But like Susan said, we in MoneyCube would certainly suggest to all employers, do it now, but do it so you can start a private arrangement, what you would currently do for your staff. And it doesn't matter how many staff you have, there's a pension option for any employer to take out a pension for their staff, where they can contribute and the employee can contribute as well. And that has benefits, a number of benefits, because there will be more control. You decide where this pension is going to sit with, not the government. Your staff get to choose the funds that the pension invests in, and they potentially, if they're higher earners, will get a greater amount of tax relief on their own contribution. As Susan points out, it's 25% essentially for an employee if the auto-enrolment scheme is used. If they're a higher earner and they're on the 40% tax bracket, they will get 40%. Currently, that is the rule, that they will get 40% tax relief on their personal contributions to that company pension scheme. So that is a much more attractive proposition to your staff than what the government will offer in auto-enrolment. So if you can get ahead of the curve now with something and put it in place, there's a lot more benefits to it for staff, but also for employers. There's also a rule in current legislation for company pensions that if an employee leaves within 2 years of joining the company, the employer has a choice to claw back the employer contributions that were given, which won't currently, under the rules at the moment for auto-enrolment, isn't going to be an option. So there's a number of different ways that an employer could benefit, both from a staff engagement point of view, from wellness of the staff's financial wellness being, and from their own control and their own finances as well.
Will the contributions from the government from auto-enrolment apply to directors and business owners as well, or just employees?
As far as I know, it's across the board.
Is it?
Yeah,
everybody.
It's all employees. Yeah.
So they'll technically be contributing to
if people are already in a pension fund. So what you'll find with a lot of business owners is the directors, shareholders might already have a pension fund set up. And so when auto-enrolment comes in, it might just be put in place for the staff members, because the directors are already participating in a pension fund.
Well, going forward, like let's say if you're starting up a new company in 3 years' time or whatever, it's across the board basically.
Yes.
Okay. It's a daunting prospect as a business owner to suddenly have that, that 6% you have to think about, like on top of, already the salary and stuff,
It is, and As well, what business owners have to look at is the pension payments that they're currently paying for themselves. They are something that the company gets a tax deduction for. So again, the contributions are something that the company will receive a deduction for. But also, we're often being asked if people are putting together a package for, a key employee, how can I remunerate them? Because the income tax rates are a high level in Ireland.
Yes.
And so if you had a new employee, there's often benefits looked at like company cars, but pension funds are something that people often don't consider. So it is something that is worthwhile looking at. As I say, the company fund and the contributions into the fund from the employer are something that they will get a tax deduction for. But it could also help, maintain a key employee member and stuff like that.
Okay. So, Jared, this is a very selfish question, but like, how can I make, as a business owner, how can I extract wealth from my company and make it more tax efficient at the moment?
Yeah, I think Susan would be
this,
very, very involved in this side of the business. I suppose I would say business owners are uniquely aware of how much income tax they pay.
Oh yeah.
They would be very on top of their taxes actually. So I mean, you have to take a salary, you have to cover your lifestyle costs. But once you've covered your lifestyle, you should be focusing on other methods. So for example, if you pay yourself a bonus, if you pay yourself a dividend, they will attract income tax. And if you're a higher rate taxpayer, that's 40% income tax plus PRSI and USC on top of that. So you're talking about losing half of those hard-earned profits that you've built up. So pensions is a really unique mechanism to extract profit in this way. So if you have your employer make a contribution to the pension scheme on your behalf, there's a couple of key tax advantages. So that the company itself can get corporation tax relief at 5.5%.
12.5%.
The employer contribution doesn't trigger an income tax bill for you personally. So there's no income tax payable as a result. It's invested in the pension scheme, and pensions have a unique tax treatment in Ireland that pensions can grow tax-free. So there's no capital gains tax on your pension. So if you invest it and you can grow your fund is growing tax-free until you retire. And even in retirement, there's more tax advantages. You can receive a tax-free lump sum from the pension on retirement, up as high as 200 grand. So there's tax incentives both in terms of contributing, how your investment is treated, and at retirement, which is unique in the Irish landscape in terms of wealth extraction, but also this retirement planning piece, which we're trying to promote for business owners.
Okay, Susan, is there any other reliefs we should be aware of or should be tapping into?
Yes, if people have worked in the business for a number of years and they're coming up to retirement age, one of the key ages would be 55 onwards. So from 55, one of the reliefs they're able to avail of in family businesses would be the retirement relief.
Yes.
Now the retirement relief would allow, and it's an individual relief, and it's a relief from capital gains tax, which is 33%. Up to 750,000 could be extracted by an individual from the business, and that could all be tax-free.
Okay.
Now, if the amount is in excess of the 750,000, the rate of tax on it then goes up to 50% on anything over and above the 750. So this is a key figure.
Is it only family businesses or?
Yes, there is restrictions. There's certain restrictions. So the first thing I'd say, if people were coming up to that age or considering retirement, do talk to their advisor, because there's a lot of conditions attached to it. There's conditions in relation to the number of years they've worked in the business. Also to do with the fact that they need to be receiving a salary from the business over the last number of years before retirement. So once all the conditions are met, and if the consideration that they're being paid for the shares doesn't exceed the 750, they would be able to receive that amount of money tax-free. And again, if you have two shareholders in the business, a husband and wife, let's say, and if they were selling up the business, for them, each of them might be able to receive up to 750,000 each. Now, the age then changes when somebody is over 65. That 750 then will drop to 500,000. So if somebody didn't avail of it before 65, the amount that they can extract is reduced. So again, it is important that it is looked at.
Reverse incentive or something.
Yes, and that's why we'd always say to people to plan. People even in their 40s to be looking at it, and if you're, not only are you interested in the planning for the business, but you're interested in your retirement. It may not be happening for 10 or more years, but it is something to plan for. And pension planning is something that often is key as well, because the building up of cash in the business could often be an issue with regard to some of the reliefs that are available. So by putting money into a pension fund for the last number of years before retirement can often, help to ensure that you've met all the criteria, that you don't have too much cash build up in the business.
Okay.
Another relief that would be available would be the entrepreneur relief. Now, you don't have the age restriction there.
Yes.
The entrepreneur relief would have on the consideration up to €1 million, and the tax on that, instead of being the 33%, it's down to 10%.
What justifies or what's quantified? Who's an entrepreneur and under what category? What's the criteria for definition?
Yeah, there would be conditions in relation to the percentage that they own in the business. So they'd have to own more than 5% of the shares in the business. Also, they would have to be working in the business in a managerial capacity. Yes. So it wouldn't be open to everyone who has shares in the business, but it would be the people who are owning and managing the business. So they'd have to have a shareholding in it, but then they're also a key managerial employment. And but again, you don't have to be up at that retirement age. So there can be people who are in their 30s and 40s who have received entrepreneur relief. And again, anything in excess of the 1 million, the CGT rate of the 33% then comes into play. But again, up to €1 million is a very significant amount of money, that they'd pay for on the shares.
In my head, I'm like, hold on, I'm an entrepreneur, I'm in a family business. Can I get both, or can I only get one or the other?
One or the other.
Okay.
So again, and you have to look at each scenario on its own merits.
Yes.
And what would suit you may not suit somebody else in a similar business. Okay. Again, it can depend on percentage shareholding, other shareholders in the business, number of years you've worked in it. So again, all them conditions need to be reviewed, and if you meet them, then you can see, are you eligible for the reliefs?
More beneficial, obviously.
Yes.
Okay, fair enough. Olive, is there anything we should be doing to protect? Is there any protections we should be putting in place as a business owner and an employee?
Yeah, there are. Certainly in a situation where you own a business, maybe with another partner, that's not your spouse, you should definitely consider life cover that would cover the event that one of you might pass away. Wow. The shares of that business that you co-own will go to their estate. So
whose estate?
To the deceased person's estate.
Right.
So that might mean their spouse is now your business partner.
Oh gosh. Okay.
Yeah.
So I actually never consider that.
Yeah, and it's something that a business owners,
thinking about that.
In partnerships, it's really overlooked. So there is you can take out life cover, which is quite cheap. The company pays for it. You take out a plan on each other.
Yes.
So with that, your business partner passes away, it pays out to you. Yes. You now have enough money to pay to buy out their spouse with those business shares. Now you own the company wholly, so you might look for another business partner to invest with you, but you've retained control. You do need to put some legal agreement in place, a buy-sell agreement, where you both agree that that's the plan of action with this fund, that when one of you dies, that's what it'll do. But that's really key. I mean, like you say, a lot of small business owners overlook something like that.
Sorry, would you need a life insurance policy as well?
It is a life insurance policy.
So if I got this, I could cancel my life insurance policy?
I wouldn't say to do that, because what it's doing is it's specifically used for, it's just an ordinary life insurance policy, but it's specifically put in place for the purpose of buying back those shares. So the amount of cover you put in place for that particular plan will be just the value of the shares of the other partner, to buy those back. We would say put life cover as well in place, though. And not just life cover, income protection is a really vital plan for people who own their own business, because imagine you are unwell, you get an illness that might not be life-threatening, but it's going to keep you out of work for quite a long time. Exactly. And you might recover from it, but you're going to be in hospital or at home recovering for months at a time. There's a plan called income protection, which you can take out. It is a little bit more expensive because of the range of what it covers. Yes. It basically covers anything. You could be in a car accident and be laid up in hospital with broken bones and not be able to do your job. It'll cover that. The cover, what it does is it pays out an income. So again, your company can take it out, paid for by the company, so it can be offset against your taxes. And it pays out the income to the company. Mm-hmm. So you can use it then to either hire
somebody else,
or give you the income. The company can pay it to you as an income, and in addition, it can also cover your pension contributions.
Okay.
So you can take out the insurance to cover both your income, a percentage of your income, there is a cap on it, a percentage of your income and the pension contributions that you make as well.
Wow.
So you could continue, you could be off work, your business could be still operating because you've hired somebody with the income, and your pension is still getting contribution.
Okay.
So, you know, your retirement planning is not, because potentially in some of these income protection claims, they can go on for 10 or 20 years. Wow. Some people may not go back to work from them. A lot of people do, and most of them now offer, the providers will offer a recurring claim option. Okay. So you might be coming in again.
Every year, annually or something?
No, just if you go back to work,
yes,
you will get a lot of rehabilitation support from the companies. The providers of this type of insurance do a lot to try and get people back to work. And if you go back to work and you become ill again for the same or some other reason, you can be off cover. You can be on claim again. You're not. It doesn't cost you more. You won't be charged more, because it's not like health insurance, because you had a history of that claim. You go back on your cover for the same cost that it was before, and you can claim again in the future if you ever become ill again. So you could have multiple claims in your lifetime.
I actually think my mind is a bit blown now. Never occurred to me. I've got to be on the phone straight away to my sister going, right, I'm taking the insurance policy out, it's to you.
There you go, that's good.
This conversation. So I guess like what I've learned, and I'm hoping everybody who's tuned in this lunchtime has learned as well today, I suppose the key take homes are, A, get an insurance policy against an income insurance. You don't have to, obviously, but it's really important.
We would certainly recommend it.
B, look at all the ways you can extract, you know, use all the tax reliefs to your benefit. And, you know, like I didn't realize that you could have one or the other. And so we have entrepreneurs, we have a family, there's lots of different ways to, I suppose, you know, be clever about where your money is going forward. And then ultimately use as much money as you possibly can for the pension schemes, you know, and do it now before the auto enrollment comes in. This is the kit, and is that kind of the gist of what we're saying? There's the kind of 4 key take homes.
Absolutely, yeah, definitely.
Okay, but I mean, ultimately, talk to a financial advisor, because they are going to put you in the right direction. It's a lot to take on, and every situation obviously is different. Yeah. Okay. And as we mentioned now as well, there is a lot of this information up on the website, on Pensions Awareness Week website. You have complimentary financial advisor sessions with Money Cubed over the next couple of weeks. Yep. So it's a great time to kind of get the mind into the focus of the future and sorting everything out. And Zurich obviously also have lots of facilities, and you have lots of services as well, don't you? Yeah,
so we would work in partnership with financial advisors like MoneyCube to guide clients through that process. And like you say, there's so much complexity out there. I think it can make clients kind of step back and say, I don't really know what to do next. Yes. So I think that's key, is to have someone hold your hand through that process. What's the best pension scheme for me? What kind of protection do I need? Yeah. A financial advisor can bring you through that journey right up to retirement. And we find that once business owners become aware of these things, the first thing they'll say is, I can't believe I didn't do this sooner. I can't believe I didn't know about this. Yeah. So yeah, it's really important. It is, but I'm laughing at you guys saying earlier on the government are trying to make it more easy. And I feel like they just make it more complex. But you know, but likewise, I'm very overwhelmed by the whole thing. But I know I need to do it, and I feel like now I know my first step is, you know, get on the phone, make my appointment, sort out my pension, get my life insurance in place, figure out if there's any, you know, tax benefits that I'm not taking advantage of, and sort it out now before I get like lynched basically for auto enrollment next year.
Well, even sitting down with your accountant and tax advisor, and also your financial advisor on the pension side, we would have those discussions with the client. Yes. And again, you can see the benefits. If certain things are done, there's tax advantages to doing it. And then on the other side, again, to start the pension, or, you know, how much the 2 million, how much they need to invest over the next number of years. And then also look at the plan with regard to the retirement, that you can avail of the reliefs in the future, whether it's entrepreneur relief or the retirement relief. But again, having the conversation and putting the plans in place is the important things. Okay, so Gerard, Olive and Susan, you have been literally a wealth of information, excuse the pun, and I am going to get my ducks in a row now after this, and I hope everybody else will. And as I said, all the information is up on the website, and thank you guys so much for your time, really appreciate it, and you probably saved me a few million. Thank you very much. You're welcome. Thank you. We want to help you take charge of your pension, but of course that's easier said than done.
So if you've heard something here today that's triggered you to think, I need to take action, the Pensions Awareness team are on hand with lots of practical ways and solutions that you can implement into your own business. There's options on their website, and also there's complimentary one-on-one sessions from a Pension Awareness Week partner, MoneyCube, for the next little while. That's all we have time for today, so it remains me to thank you for our panel and to thank you viewers. Today is the first of many sessions throughout the remainder of Pensions Awareness Week, and you can still register for them online or watch sessions that have already taken place. Tomorrow there will be a session with Keeping Your Pension on Track, hosted by Gráinne Seoig, and Ryan Tuberty will also discuss a panel discussion on company pensions for SMEs later this week. There's also plenty of videos available and a range of pension topics that you can watch at your leisure. So be sure to log on to pensionsawarenessweek.ie and find out more. Thank you very much.